All right, so sector rotation. We're going to talk about sector rotation. We talked about the stock market with Faber. We talked about precious metals now. We heard from Tom Cloud. Now we're going to talk about sector rotation. And we're going to really dive into this real deeply so we can understand how we can actually beat the markets 70% of the time using a very simple, straightforward investment strategy. Now, as I mentioned earlier, a few years ago, I stumbled across an interesting white paper that was entitled Relative Strength Strategies for Investing. It was written by Faber, who you heard earlier on the program. And the paper demonstrated a powerful but simple investment strategy that outperformed the typical buy and hold strategy that you've often heard about nearly 70% of the time. Faber's research was based upon 80 years or 80 plus years of stock market data, and it revealed an astoundingly simple way to beat the market. Put simply, the strategy involves buying sector-based investments like an ETF, for example, that have recently outperformed their peers. So instead of simply buying the S&P 500 ETF, like ticker symbol SPY, this strategy shows you how to beat the return of the S&P 500 by investing in the specific sectors that make up the S&P 500. So before we get any further, maybe I should explain real quickly for those of you who are new to investing what sectors are. And let's go through each one of them and we'll take a look at the S&P 500 as an example. The S&P 500 index, of course, very popular, and there are 9 different sectors that make up the S&P 500. They're based on 9 sectors. And so the S&P 500, you hear about that on the news or you hear about that on the financial media, it's an index. It's an index that's composed of many different stocks from different sectors. And so if you can almost envision stocks like an index like a box, if you open up the box, then inside you have another box, and that's called a sector. Okay, and then you have 9 of those inside the index, in the S&P 500 index. Inside each one of those sectors, boxes, for example, we lift the lid on those and we find inside of those are industries, industry groups. So you may have healthcare as an overall sector of the stock market, but then inside of healthcare, you have like health insurance companies, and that's an industry group of the sector. Or maybe you have biotech. Biotechnology would be a industry group of the healthcare sector. So you have sectors and you have industries. Now, we're not going to focus on industries today. We're just going to be talking about sectors. Of course, you can also buy ETFs that are based upon industry groups as well. So it's very broad how detailed you can get with your investing based on sector rotation and even focusing upon different industries. But let's focus on the S&P 500. As I mentioned, there are 9 different sectors in the S&P 500 that basically compose the S&P 500 index. So let's run through them very quickly, and I'll give you the ETFs for each one of them. So the very first sector in the S&P 500 is materials. It's basic materials. And the ticker symbol that I typically use whenever I invest in basic materials, the sector itself, is ticker symbol XLB. And by the way, all of these ETFs I'll be sharing with you are the Select Sector Spider ETFs from State Street. They're very popular. They're probably the most liquid ones out there on the market. So the first sector is materials, basic materials, ticker symbol XLB. Now this includes many things like construction materials, chemicals, metals and mining. Think of companies like DuPont and Dow Chemical. Think of companies like Monsanto and big mining companies like Newmont. These are the kind of stocks that are inside the materials sector. And so materials, that sector makes up 1/9 of the S&P 500. And at any given time, the materials sector makes up a certain weight of the S&P 500. So as of this recording, the materials composes about 3.2% of the S&P 500. The next sector is energy. Of course, there's the energy sector. The ticker symbol for that one is XLE. XLE. Now, of course, we don't have to think too hard about this. Energy is pretty obvious. We have companies like ConocoPhillips. We have companies like ExxonMobil and Chevron, all the big oil companies. But there's also companies that you may not think of that are involved in energy, but maybe not oil energy. Maybe it's renewable energy, or maybe it's some other kind like wind power, or maybe it's solar energy. So energy itself composes currently about 8% of the S&P 500, and you can gain access to the sector itself through the ticker symbol XLE. All right, so that's the second sector. The third sector is financials. This is the financial sector. The ticker symbol for that is XLF. XLF. That currently composes about 16% of the S&P 500. If you break it down into a pie chart. And of course, financials are very common. You have big banks, Goldman Sachs, Wells Fargo, companies like this, Bank of America. These are the companies that compose the financial sector. Now remember, within a sector, you do have industry groups. So there are many different industry groups within the sector. So in that case, you would have regional banks, you'd have credit card companies, insurance companies. I mean, you think about all these different industry groups that are within the financial sector, and that, of course, can go on and on and on. But the overall financial sector, ticker symbol XLF. All right, the fourth sector of the S&P 500 is the industrials sector. That's ticker symbol XLI. That currently composes about 10% of the S&P 500. And industrial companies are, pretty common. I mean, you think about GE, for example, and Honeywell. These are companies involved in railways and airline companies, defense companies, construction, engineering companies, these types of companies. These are all part of our industrial sector. All right, so the fifth sector is technology, ticker symbol XLK. Now, that is probably the largest of all of the different sectors within the S&P 500. It makes up almost a fourth of the entire S&P 500 index, 22%. Now, technology, again, obvious, Microsoft, companies like Apple, Oracle, IBM, AT&T, Cisco, companies like this, semiconductor companies, computer companies, telecommunication companies, internet companies, all of these companies fall into the technology sector, and they may be in different industry groups within the technology sector, but they are all in the technology sector. All right, the sixth sector we're going to talk about in the S&P 500 is the consumer staples. That's ticker symbol XLP. And consumer staples make up about 10% of the S&P 500 currently. Now, consumer staples are, basically things that you go to the store and buy. I mean, you're talking about food. You're talking about tobacco companies. Think of, Altria or Philip Morris. They are household products, personal products, retail companies, places like Walmart that sell these kinds of products, Procter & Gamble, Pepsi-Cola, Coca-Cola, many of these different kind of companies. They all fit into the consumer staples sector, and that's ticker symbol XLP. The seventh sector in the S&P 500 is the utilities sector. Now, this one composes a very small fraction of the S&P 500 overall, just a mere 2.9%, just barely 3% in the S&P 500. And utilities are simply companies that focus on electricity or natural gas. These are the power companies, the utility companies that you pay for your water or for your electricity or for your natural gas. These are those companies. Exelon, Dominion Resources. You can go through the list and think about some of the different utility companies that are out there. That is XLU. The eighth sector in the S&P 500 is the healthcare sector. Now, this one composes nearly 15% of the S&P 500, and we can think of many different healthcare companies. Of course, Johnson & Johnson, Biogen, Pfizer. Think of all the big, pharma companies that are out there, biotech companies, Aetna Insurance, healthcare providers, hospital groups, healthcare equipment and supplies. I mean, you just go through the list and you can think of a lot of different types of healthcare companies. Now, as we mentioned, some of these companies are in different industry groups within healthcare, but they are all still within the healthcare box. And then finally, the ninth sector in the S&P 500 is the consumer discretionary sector. And this one's different from the consumer staples. It currently makes up about 12.5% of the S&P 500. And it includes companies like McDonald's, Comcast, Walt Disney, and many other luxury items. This is the type of companies that you spend money on with your extra income. This is consumer discretionary. Again, the ticker symbol on this is XLY. And again, it includes many different industries, hotels, restaurants, leisure, media, and many retail companies as well. So let's run back to that list one more time with the tickers. You have basic materials, ticker symbol XLB as in boy. You have energy, ticker symbol XLE. Financials, XLF. Industrials, ticker symbol XLI. Technology, ticker symbol XLK. Consumer staples, ticker symbol XLP. Utilities, ticker symbol XLU. Healthcare, ticker symbol XLV. And consumer discretionary, ticker symbol XLY. All right, so now that we understand the sectors and we understand the industries and how they're different from sectors, now we know that the S&P 500 itself is composed of these 9 sectors. That's what the S&P 500 is. So if you invest into an S&P 500 index ETF, you're basically buying in one ETF all 9 sectors. Now, of course, some sectors are going to outperform others each month, each quarter, each year, and that's exactly what Meb Faber's sector rotation strategy identifies, and it focuses upon that. So instead of just buying in one fell swoop all 9 sectors, this sector rotation strategy says, why don't buy the ones that are in an uptrend and ignore the ones that are in a downtrend? Why buy them all? Because the overall return, the investment return on the S&P 500 at the very end of the year is going to be calculated based upon the performance of all 9 sectors. But since some of those sectors are not going to perform as well, you can actually get ahead of the S&P 500 possibly with this sector rotation strategy by focusing upon the top 1, 2, or 3 sectors based upon their trailing total returns, including dividends. So in essence, by focusing your investments in the top performing sectors within the S&P 500, you are more likely to own more of the leaders and less of the laggards in the stock market. And this in turn can boost your returns if the current uptrend continues in your selected sectors. So the strategy is very flexible. I mean, you can invest in the top 1, 2, or 3 sectors, and you can rebalance them every month, every quarter, every 6 months, or every year. So it really can meet your schedule or your temperament, whatever, your case might be. And let me just kind of break it down on how it works. If you choose to invest only in the top performing sector, now how do you determine which sector is the best? Well, there's many different ways. Here at our website, FTM Daily, for all of our subscribers, we provide that information to our FTM insiders and to our pro traders. But you can also find it online in different places. You just want to have to go search. Yahoo Finance probably has it. You can also kind of put together your own spreadsheet of these different sectors and find them that way. But the goal is to take a look at how well they're performing, and then you have to decide, do I want to track these every month? Do I want to measure them every month and compare them and see which one's performing the best? Or do I want to do it every quarter? Or do I want to do it every 6 months? Or do I want to do it every year? Now, in the white paper that we're providing to you for free today from Meb Faber, where he details this strategy, he shows that, I believe, if I remember correctly, that every year seems to be the very best return, which I thought was a little strange. And as you read the paper, you'll kind of see why. But overall, you get to decide how often you want to rebalance this portfolio. So you take a look at the top 1, 2, or 3 sectors over a given period of time, your choice. And as the paper shows, it really doesn't matter which one you pick, although historically, you can boost your returns by focusing upon the ones that have the best historical rate of return. So I believe, again, that's every year. But it's pretty minimal, the difference between that and every 6 months. So if you choose to invest in only the top performing sector, like right now, for example, healthcare has been the top performing sector, and it has been for some time. And so I've been investing in healthcare. Another one of the top performing sectors up until last year was utilities. And so I was investing in utilities as well. But if you're only going to choose one sector, then you're going to basically put 100% of your money for that particular strategy into that sector. If you instead choose to invest in the 2 best performing sectors, then you're going to take your money and divide it in half. Then you would take 50% and invest it into the top performing sector and 50% into the second best performing sector. Now, when you do that, when you invest in 2 or 3 sectors, in these top sectors, it does slightly lower the historical return probability that you're going to receive, but it also lowers your risk through wider diversification. And if you choose to invest in the top 3 performing sectors, then your investment would be divided evenly into thirds. That is 33% invested into the top performing sector, 33% invested to the second highest performing sector, and then the final third in that final third top performing sector. Now, as far as how often you want to rebalance the portfolio, as I stated, that's up to you. You can do it every month. You can do it every quarter. You can do it every 6 months. You can do it once a year. But Faber's research does reveal that certain time frames are more ideal than others, as I hinted at earlier. But as you can see, it's a very simple investment strategy that relies on picking out the top performing sectors, and it's really kind of a trend following system, because you see, once a particular sector really begins to lead, it doesn't mean that it'll always lead, but it may continue to lead for a period of time. And as a trend follower myself, I can tell you this fits right in to the kind of trading that I like to do and the kind of investing that I like to do. So this has been hand in glove, for me. It's a very simple investment strategy. It's easy to implement, has historically beaten the underlying index returns about 70% of the time. So if this sounds interesting to you, if this simple sector ETF rotation strategy sounds like something that you might benefit from, I urge you to download and read Faber's 22-page white paper right here on our website. You can go to the show notes today and take a look at ftmdaily.com. It's a quick read. It contains some really interesting insights, especially how changing the time frame that you're investing or changing the number of sectors that you're investing in can really optimize the portfolio for the best possible returns. Now, you should also know that the white paper does not actually refer to the S&P 500. Faber's paper is actually focused upon a different index. But that's okay, because the strategy can work across any different kind of index. It can work even in foreign stock markets and other asset classes. But on a personal note, I want to tell you that I've been personally using the sector ETF rotation strategy for about 2 years now after stumbling across that white paper, and have been very pleased with the results. I personally choose to rebalance my sector ETF investments every single quarter. So after reading the paper and after doing my own research and due diligence, I discovered that every quarter, every 3 months, I would go in and I would take a look and see what the best sector ETF is, and I would make sure that I was in that sector ETF for the next 3 months. And in fact, I'm actually sharing those sector investments with all of our FTM insiders and pro traders. So if you'd like access to that, of course, you can go to our website, click on the plans and pricing, become an FTM insider or a Trigger Trade Pro subscriber. And when you do, you'll unlock access to those areas where you can actually see which ETFs that I am investing in for the purposes of sector rotation for this strategy. So it's a really great strategy. I think I've really been pleased with it. And I tell you what, you can even apply it. I mean, this is really just a concept that you're going to learn in this white paper. It can really be applied, as I mentioned, to other markets. But one of the things that I've been messing with a little bit lately is taking this strategy and actually going beyond the sector ETFs and going down and drilling down into the industry ETFs. So as I mentioned, healthcare is just one sector of the 9. But within the healthcare sector, there are other types of industries, of course, pharmaceuticals, biotech, and things like that. Well, what I have been messing with and what I've been doing some back testing on is, instead of just investing in the top performing sector, what if I were to drill down into that sector and find out what the best performing industry group within that sector